Okay, I think we'll get going. Welcome, everyone. Thanks for joining us today. This is M&P's Business Owner Series. Today, we're going to be focused on ExitSmart Succession Planning. My name is Craig Maloney. I'm a Managing Director in Corporate Finance and Valuations. I lead our team here in Atlantic Canada, and joined by Sebastian LeBlanc, Senior Manager, Corporate Finance and Valuations, and also Earl McLeod, who's the Atlantic Regional Tax Leader. Welcome, everyone. Today we're going to be our first introduction section, and I'll give you a bit of an update of the 2022 succession update in the COVID world. We'll talk about elements of good succession. We'll discuss business value and exit options, and then Earl will close it with some planning opportunities, and we'll leave some time at the back end for conclusion and questions. And there is a Q&A function, which you'll see on your bottom bar. If throughout the presentation you have any questions, please populate them in that section, and we'll do our best to answer them at the back end of the presentation. To the extent that we can't answer them within the presentation, we'll certainly connect with you offline after the presentation is over. So some key issues of succession. Really, it's tough to determine when is the right time to sell. You have to assess how ready you are and what is your ability to achieve your goals and objectives. We underline bold your there because it is really applicable to you. There's no one-size-fits-all plan here. There's a number of steps, processes, policies to follow, but really is about your goal and your objectives. Sebastian's going to talk a bit about understanding business value, and really a little bit about identifying opportunities and maximizing shareholder value leading up to a sale. We'll talk about evaluating the pros and cons of a third-party sale versus selling to the second generation or perhaps a management team. It really is a balance within a family business between the first generation's need for their financial security and liquidity and retirement goals versus the second generation's desire to retain the business and fund that acquisition for the first generation. Have to consider how we market the business and how to identify buyers. It's usually something that only happens once within a family's lifetime, so you want to make sure you do it right. Financial security. Oftentimes, the business is the most valuable asset of the family. A lot of times it's more valuable than the home, obviously, and really want to make sure you maximize that value in order to maintain the legacy of the family. Also, we want to consider some family contingency planning, which Earl will talk to on the back end, as we mentioned, ensuring beneficiaries are protected. And there's also wealth and tax planning that can happen in advance of the sale to make sure the after-tax proceeds are maximized. In our experience, formal succession plans are very rare. So if you don't have one, you're in the majority. And that's what we're here to just start discussing, how to plan and how to think about and how to ask the right questions, really. We'll poke on some of those, and hopefully we'll have some follow-up conversations with a number of you to help to develop those plans down the road. It's common for smaller mid-market businesses to be passed on within families, which has happened a lot in the last 6 months through a new bill that was introduced called C-208, which Earl will touch on briefly in the tax planning measures at the back end of the presentation. Private companies aren't always positioned, I guess, to maximize value at the time of sale. Sometimes, it makes sense to sell to a management team or to sell within the family, but that doesn't necessarily mean the maximizing value. Again, it's your plan, your decisions. Owners often make decisions independently without using advisors. So they sometimes just rely on themselves. That's what they've always done. I guess I would just say we're here to help, as are others within the professional community. I've been on the 2022 succession update. The world did not end, but most of the rules changed. So what happened in the last 24 months? Well, it was a little bit chaotic. I think we would all agree. Things shut down, then they opened up, they picked up, they opened up, and then they closed down again and back up. It's all over the map. Some businesses thrived and did quite well, while others struggled through the pandemic and are still struggling. Some consequences, construction is still booming throughout Canada. Retail and manufacturing are struggling a little bit. Again, we see businesses struggling up and down, taking advantage of some of the subsidies and whatnot available, but there's been a lot of up and down within the overall community. Business families, we found have been doing a lot of thinking about their future, more so than in the past, say, 10 years. Bottom line, most of the rules change and people struggle to make sense of the new reality. We're having a lot of families come to us with philanthropic thoughts, I guess, for those businesses and those families that are doing quite well. They're in a different state than they probably thought they would be, which is interesting. I think a lot of us would not have thought of that probably 2 years ago at the start of this pandemic, but again, some businesses have been thriving throughout this, which is quite interesting. Families are looking at options to hold their business interests long term, and we've been doing a lot of planning around that as well. A lot of emphasis on work-life balance, as I'm sure it's no surprise to a lot of folks on the call here. Employment has been a struggle in many industries. It says there, the war for talent. That's across every industry. We've had challenges in our industry as an accounting firm. I know manufacturing clients have had issues. Just about every industry is struggling to keep and maintain good employees throughout. It's been a struggle for everyone. Just a brief update on the M&A market. It's still quite active, still very hot. Deals are getting done for good businesses. There's a strong appetite in the market for good companies. There's a number of buyers out there. Probably get calls every week, I'd say, from a buyer or buyers looking for a good, solid business. Banks are still lending at very nice, attractive levels. Interest rates are going up, but still within historical terms are still at reasonably low levels, which means that values are still quite strong. Some elements for good succession. So we're talking about the overall big picture succession here. Many layers, many facets to a good plan, and really it is about developing a good plan. It typically requires different skill sets. There's a quote there: accountants are not professionally trained therapists. So it's good to lean on many advisors, if at all possible, who have been through succession planning to help guide you through. Succession planning is a process, not an event. Some may have heard that term before. What that means is it evolves. Once you've begun a succession plan, doesn't mean you're done. Things change, businesses evolve, things like COVID, family changes, industry changes. So you have to continually plan for that when you're going through that. Focus on the sustainability of the business and continue to look at it and evolve it as you go through the planning process. Tax minimization is one facet of the overall, and you want to look at your retirement of the exiting owners, considering wealth transfer and parity usually amongst family members, but not necessarily all the time. Transfers often happen in small pieces if it's amongst family or management. And if you do plan, it does have the greatest likelihood that the business will continue and the legacy will continue. The three-circle model, we're guided by this a lot when we help families go through a succession plan. Some may have seen this before. So there's three circles: the family, the ownership, and the business. And there's different facets involved with each, and really focus on the elements that overlap. So within the family circle, when we're talking about succession, we want to consider who should be making the key decisions. What skills does the family require, and how will it access or develop these skills? Who is included and excluded from ownership participation? Who wants to stay involved in the family business? Not everyone always does. And what tax and legal structures would keep tax low and legal protection high? All questions to answer in the planning process. In the ownership circle, we want to consider, should non-family members become owners? Example, key management or employees. What are the retirement plans and goals of the owners? How much do the owners need to retire? How will the transactions be structured and financed? There's many different ways to accomplish this. Who should have legal and operational control of the entity? And how will ownership control and value transition over time? Again, there's no one size fits all. There's no right answer. It's just whatever fits for you and your family situation. Within the business circle, how can value be maximized for a future sale? Business may be sold in the next 6 months, or maybe sold in the next 6 years. And there's different things that can be accomplished to maximize that value within the time period that fits for you. Do family members have an automatic right to employment and compensation? It's a situation and question that probably affects a number of families. What governance models will work best for guiding and directing business interests? We've developed a plan at M&P called the SMART Plan, which focuses on succession, maximizing value, asset and wealth management, retirement needs, and tax planning. Again, as I mentioned earlier, there's no one-size-fits-all solution. Good governance results from developing family vision, values, and goals, identifying family governance priorities, implementing regular family meetings, and educating the next generation. Building the right succession strategies requires clear goals and thorough planning. And M&P has several smart solutions, as we mentioned, and we'd be happy to discuss if those make sense for you. It's important to really take the time to effectively maximize the value you've worked so hard for. So with that, I'm going to pass it over to Sebastian.
Thanks, Craig, and hello, everyone. So today I'll touch on two topics that could be of interest when exiting your business. The first one being the fundamental business value concepts, and then we'll also touch base on some of the common exit options that are available to you. So today we wanted to provide you with a high-level overview of some of the common business valuation terms that could be discussed in the context of a transaction. With that being said, there are multiple approaches and methods that can be used to value a business. And while we won't have time to go over each and every method during this presentation, it's important to understand that the person assessing the value of the business would need to consider facts specific to the subject business before determining the most appropriate valuation approach. So with that being said, there is no one-size-fits-all approach when it comes to valuing a business. So for the purpose of today's presentation, we will focus on the multiple of EBITDA method. So some of these terms used in this method often come up during discussion with folks looking to sell their business. And so for those of you who aren't familiar with the term EBITDA, it stands for earnings before interest, tax, depreciation, and amortization. So EBITDA is a debt-free cash flow measure that measures the funds generated by the business that are available to for providers of capital. So the multiple of EBITDA method could be used by a buyer looking to value a going concern operating business with relatively consistent earnings that does not require significant investments in fixed assets each year. So such a business is generally valued as a function of its future cash flows and the risk in achieving those future cash flows. That's why EBITDA is particularly relevant when applying this method, given the fact that buyers could typically use this as a proxy for future cash flows. So in the context of a transaction, buyers may want to normalize EBITDA, so adjust it for unusual, discretionary, or non-recurring events that may have impacted historical results. Thus, when determining the future earnings potential of the business, they will generally normalize and adjust historical EBITDA items that are not anticipated to occur in the future. So on the screen, you can see here's a few of the common normalization adjustments. One of them being non-market transactions. So in this case, good example of that would be an owner manager of a business not being compensated at market rate or being compensated above market rate for tax planning purposes. And in this instance, the EBITDA normalization adjustment would be the difference between the actual compensation paid to the owner and the market compensation that would be paid to an individual with the same roles and responsibilities. You could also look at adjustments for non-recurring revenue and expenses, such as one-time commissions or abnormal repairs and maintenance in a given year. There's also consideration that could be placed on unusual or discretionary items that have affected historical results. So once a buyer determines normalized EBITDA under this method, they could then look at selecting the appropriate EBITDA multiple. I'm sure a bunch of you have heard the term multiple in past when you're talking about business valuation. So for those of you who haven't, the EBITDA multiple represents a rate of return used to convert the normalized EBITDA into value. So there's a direct relationship between the selection of the multiple and the inherent risk in the underlying cash flow to which it's being applied. So again, just like we talked about the valuation approach, there is no one size fits all for the EBITDA multiples. So each one are subject to economic, industry, and company-specific risk factors. So at a high level, by applying the normalized EBITDA to the EBITDA multiple, somebody could derive the value of the business or the core operations of the business. At that point, there are other considerations that one may want to give to the value of the equity holdings of the business, which include redundant assets. So redundant assets are assets that are not necessary for the core or of the operations of the business. So a vendor could remove these unnecessary assets before the sale transaction, or if they're not removed, they could ask for fair compensation above and beyond the business enterprise value we discussed previously. And then as we keep going here, there's also consideration that should be given to interest-bearing debt and deduct that from the business enterprise value to arrive at the equity value level. So again, it's important to understand that a person assessing the value of the business must look at all the company-specific facts to determine the most appropriate valuation method. We just kind of wanted to show an overview of one specific method, but it does not mean that that's the most appropriate method for your subject company. We invite anyone to discuss business valuation concepts with a business valuation expert, such as a CBV. So moving on to the next slide. So here we have a few company-specific considerations that could impact the value of a business. So to highlight a few of them, we could look at customer concentration for one. So customer concentration essentially refers to the way in which revenue is distributed amongst the customer base. So if a subject company would have 40% of its annual sales coming from one key customer, this would make them heavily reliant on the key customer. And in order to compensate for that, one could adjust the multiple used in that context to reduce the EBITDA multiple because of the increased risk in the future cash flows. There's also the strength of the management team that we could look at. So a strong and proven management team could be a factor that decreases overall risk in achieving future cash flows. So in this case, this could lead to a higher EBITDA multiple under this method. So overall, planning for your exit, the exit of your business, could involve strengthening a number of these items that you see on the screen in hopes to maximizing the value upon your exit. So developing a comprehensive action plan to improve these items is key to a successful exit. So now we'll talk about a few common exit options. So this is not meant to be a comprehensive or exhaustive list of options, but we're highlighting a few of the common ones. So the first one that you can see here is closing down and liquidating the assets of the business. You would then distribute these the after-tax proceeds to the owners. So generally speaking, this is an unfavorable option, given that it tends to lead to the least amount of value retained by the owners, because you're selling off individual assets as opposed to a business unit. You could also consider selling to a third party in the near term. So this option would provide you with the ability to exit the business sooner. And in some cases, the market may be in your favor, and it may be best to look at an immediate sale. As Craig mentioned earlier, interest rates are low. So for buyers, they might be able to increase the amount they pay for a business. So an immediate sale might be in your best interest. On the flip side, you could also sell to a third party in the future. So this option creates a runway for the business owner to prepare the business for the sale. So it allows the business owner to address any potential operating issues or financial issues. You could also provide an opportunity to clean up financial reporting or budgeting practices, which could then lead ultimately to a more successful exit. Then there's also the option of looking at management buyout. As Craig mentioned at the top of the presentation, management could be a key potential buyer in your succession plan, where you already know the buyer. It sometimes makes it easier to sell the business to the management team, assuming that it's financially feasible for them. And then finally, there's always the option of selling to a family member, if the case is appropriate for your specific condition. So in choosing an exit option, it's not an all or nothing decision. So you don't need to select one of these highlighted options. You could do a combination of any of them. So in practice, we often see the management team partnering up with a private equity group. And so together, they could buy out the existing shareholders. So you would then have a third party coming in with a management buyout. So the two of them would partner up and make sure that you have a successful exit of your business. So to highlight some of the implication of the selected approach, each option will look different for each family and business. The options will require different levels of planning and structure, as Earl might allude to in his part of the presentation. So therefore, it's important to consider how your exit options will affect your overall exit goals, so you can adjust your plan accordingly and manage the expectations. So here we have a few of the pros and cons of each of the selected exit options. So a full divestiture would mean that you would be selling the entirety of your holding in the business. So obviously this provides with maximum liquidity at the personal level, and it offers you the opportunity to exit the business, and you can mitigate against future market downturns or industry downturns. So that's another positive fact. On the flip side, or on the disadvantage side, it would restrict your future ability to be involved with the business. And then again, if the business for some reason would increase in value or would grow in value, as we hope, you would then miss out on the opportunity of the future growth, as that would be retained by the new owner. So then there's also a partial divestiture. So a partial divestiture would mean that you wouldn't sell the entirety of your interests or your holdings in the business, but only a portion of it. This would provide you with personal liquidity upfront, which is great. And some of the disadvantages, however, of this method would be that you're introducing a new financial partner that you may not be familiar with. So you gotta be in the same wavelength in the decision making with them going forward. And also it dilutes your ownership within the business. So if there's a prospect for future growth of the business, you're not going to get full credit. you would only get your fair share based on your holdings at the time. Then we've talked about management buyouts earlier, and then obviously this one offers again immediate personal liquidity. And using a management buyout option would reduce the due diligence process significantly when looking at an acquisition. This is because the management team would be familiar with the operations of the business, so they would lead to a bit less questions on their part. But however, one of the disadvantages of this is it's not uncommon for sellers to have to finance a portion of the purchase price. And by that, they would issue a vendor note. So this leaves the owner, the exiting shareholder, with some business and financial risk. Because then you need the new management team to operate the business in such a fashion that they are able to repay the vendor note. And then lastly here, we have passing on to a family member. So overall, the complexity and the cost of the transaction process could be less in this scenario. It's also important to consider the fact that some of your customers or your employees might already know your family members, so it creates a bit less disruption within the business operations. But again, if we look at some of the disadvantages, this could cause potential conflicts and arguments within the family, just given the financial nature of a transaction. And then also, as Craig mentioned earlier, not everyone is interested in participating in the business, and not everyone has the aptitude of running the business. So in some instances, it may be best for the family unit to maximize value through another means. So with that, I'll pass it on to Earl to talk about some planning opportunities.
Thank you, Sebastian. So I'm going to chat a little bit now about some of the planning opportunities and the tax implications that are involved when looking at doing a sale of a business. So the slide that's up there now is a representation of the various tax rates that we have available. These are Nova Scotia rates. We have the dubious distinction of being at the higher end of the rates across Canada. So if you're looking at this from a different province, the rates will be slightly lower, but they would be representative in terms of sort of the distribution that we're seeing here. So when you're looking at a sale, if you're able to claim a lifetime capital gains exemption, you'll see on the left-hand side that you potentially can get away with selling the shares of a business and potentially avoiding all income taxes, because that entire gain would be exempt from tax. If you're not able to utilize the capital gains exemption, or the business sells for an amount that is higher than the exemption balance of $913,000, then there may be a part of that capital gain that would be subject to a capital gain tax, and that tax rate would be subject to a 27%. And that, of course, these rates are listed as the top rates. And then, so just looking at other rates which become important depending upon how the business may be structured in terms of how the sale is going to happen, you may be looking at potentially a dividend, and that dividend can come out as either an eligible dividend or an other than eligible dividend. And those rates are between 41 and a half and almost 50%. So you can see there's obviously a wide variant between being able to sell the shares for zero if you're able to claim the lifetime capital gains exemption, or being subject to a dividend at 48%. So obviously as a seller you are biased to try to reduce that tax rate down and generate a capital gain. And of course, CRA is on the left-hand side there, which is anti-avoidance, which is basically pushing transactions out of these lower tax rates if they don't qualify, and pushing you up into income amounts that would be subject to these higher rates of tax. This becomes important as we start going in a few slides here talking about the changes that Craig had mentioned that came through this past summer with Bill C-208 and the transition of family business. So next slide, please. So in looking at basically, the planning, and this could be, a few years before the actual sale takes place, and trying to get yourself prepared for selling, which is ideal and optimal, and that's what we would typically, like to see our clients do. But some of this is also, discussions that will actually happen, or planning that will take place right around the time that the sale is to happen. So the first one is really sort of looking at maybe as you're going through and thinking about whether or not you are going to sell, looking at whether or not there are past issues that need to be addressed. And this may result in actually going back, fixing either non-compliance or fixing errors that may have happened in the past, and just trying to get those errors cleaned up with CRA so that they don't become issues later on when you're actually negotiating your sale. The other reason why this is important is because, as we will generally see, some of the values that were going to be reported can be fairly significant in terms of the size and the amount of tax that will be generated. And that typically will result in CRA taking a closer look at your tax return. So if you have issues, they are more likely to potentially arise and come to light when you have one of these large events happen, and the income that has to be reported from that sale. As alluded to already, the lifetime capital gains exemption is a very important planning tool in terms of the sale of the shares of your family business. You can exclude $913,630 of a capital gain from your income if you're able to utilize the lifetime capital gains exemption. That results in roughly $250,000 in tax savings. So, a very significant planning opportunity if you're able to utilize it. Now we're going to get into talking a little bit more about, exactly how that works. But essentially there is a three-part test. You have to look at whether or not the shares of the company that you're selling, whether they would qualify as a qualified small business corporation or a qualified farm or fishing property. So, those are specifically defined in the Income Tax Act in terms of, needing to be privately owned companies that are Canadian controlled. But in addition to that, you would need to have held those shares for 24 months. And over that 24-month holding period, the assets in the company would need to be active. What active means is that they would need to be actually used in the business. So surplus cash or an investment portfolio that's not necessary for running the business would not be considered active assets. And potentially, if the amount of those assets are large enough, they can throw the value of the business offside of that 50% test, then you would not be eligible for those shares would not be eligible as qualified small business corporation shares. And then at the time of the actual sale, that test rises from 50% to 90%. So, typically there will be a number of planning opportunities that would be taken into consideration to basically get a company on side for the date of sale. Looking at the structure of the business, there may be things that we can do in advance to, do some planning and to make sure that we can take advantage of the best opportunity for, for a future sale. So if the value of the company is substantial, so you've got a business that is, $4, $5, $6 million, then you have the opportunity, if the facts patterns bears it out, that you potentially have the ability to multiply that capital gain, that lifetime capital gains exemption. And that would typically be done through, the use of a family trust, where you would have the shares held in a family trust. You would have a number of family members who would be considered beneficiaries of that family trust. And then when the capital gain arises on the sale, you have the ability to allocate that capital gain out to those family members. And each one of those family members has the ability to utilize their own capital gains exemption. So obviously that's not something that we can do right at the time of sale, because if you're going to be trying to do that type of planning, remember you need to have those shares held for at least 24 months before the sale. So that trust would need to be in place at least 2 years prior to the sale. So if that hasn't, if that type of planning hasn't happened, and you've got an imminent sale, then unfortunately you would be blocked out of that. So that's why we'd be looking at trying to do this in advance. The other one is called purification. So as I had mentioned, you've got categories of assets that are passive and active. By utilizing a proper structure, we would have the ability to maintain the company on a pure basis, so that you don't end up having to do a bunch of last minute planning. So if the company is building up excess cash on a regular basis, having a proper structure in place will allow you to be able to remove that cash on a tax efficient basis, so that when the time comes for a sale, that company will be on side and qualify as a small business corporation. Point number 4, talking about the sale of assets or shares. So we typically will do this type of calculation. So we talk an awful lot about the lifetime capital gains exemption and the ability to utilize that. And as we'll see in one of the next slides here ahead, there is preferences by the buyers in terms of what they would like to buy, and often they're looking at wanting to buy assets. The owners of the business, the family, are looking to sell the shares of that business so that they can get the capital gains exemption. But by running the numbers and actually seeing what is left over after all the taxes, corporate and personal, have been paid, it may in fact result in not much of a difference, or perhaps simply by selling the assets of the company, you're able to generate a higher price because the buyer is more motivated to buy those assets. So it does require, as I said, a little bit of a calculation to go through and take a look at that. And then number 5 is just all of the due diligence and looking at the documentation. So this would happen more so at the closer to the time of sale, although as you're getting ready and looking at the business, you probably want to start going through and compiling this up. And again, this feeds back into possibly point number 1, where you see that you've got issues that need to be cleaned up. But certainly as you're going through the negotiation process, a buyer looking at this, if it's an outside buyer and not the family, they're going to want to make sure that tax filings have been done properly. That would be for payroll, HST, as well as income tax, looking at contingent liabilities. As a seller, you're probably going to be asked to provide reps and warranties to make sure that the buyer is comfortable that that all of this has been handled properly in the past. Next slide, please. So just very quickly on C208. So this is the bill that came out over the course of last summer that sort of leveled the playing fields between a family selling intergenerationally and what they would have been excluded from being able to do prior to this bill coming in. So very quickly, before this bill had been introduced, it typically resulted in a more tax efficient way to sell a business to an arm's length third party or an unrelated third party than it would be to transition that business to from parent to child. And I've just used an example here that if we had a $2.5 million valued business that's owned equally by mom and dad who have the full ability to utilize their lifetime capital gains exemption, if they sold that business to an unrelated third party and they were able to sell the shares, it would result in roughly $182,000 of tax. So they'd be able to shelter roughly, as I said, 913,000 of the gain. There'd be a small amount on that gain that would actually still be taxable, but which would be subject to the capital gain rate. And between the two of them, they'd pay the 182, which, you know, is about a 7% tax on the sale of $2.5 million business, which is a pretty good result. If they did that same transaction and tried to sell those shares to a child, and they tried to sell using the child, you know, getting a corporation to purchase that business, then there's going to be a conversion of that capital gain into a dividend. That dividend, if the whole amount of the dividend is taxed at the dividend rates, you're looking at $1.2 million of tax, so a substantial difference. If the child were to enter into that transaction and not use a corporation, and it's the corporation that the child would be trying to use to buy the shares, that would actually create the issue. So if they bought those shares personally, they're going to have to fund the purchase price. That purchase price is probably going to have to come out as dividends. They're still going to be resulting in dividends that they're going to have to pay. And while that may be able to spread out over time, they're still going to be looking at a substantially higher price. So what C208 basically said was to level the playing field so that you know, a child would have the ability to utilize a corporation. The reason why you want to utilize a corporation is to be able to use after-tax dollars to be able to finance the purchase, which would result in essentially the parents being able to sell the shares of their business to their child, and the child being able to you know, to finance that at a tax efficient way, and for mom and dad to basically walk away with, you know, more money in their pocket and less taxes to the government. So, you know, it was a very key piece of legislation. However, you know, it did come with a significant amount of trepidation by the government, because they felt that, you know, there's ways that this could be utilized to effectively, you know, have families strip money out of the company, and you know, and not result in what would be otherwise, you know, real transitions of businesses from parent to child. So they've come out, they said they're basically going to be providing some amendments to this law. This particular bill was passed as a private member's bill, so it wasn't actually introduced by the government. But the government is saying that they're going to honor this. They're going to actually, though, require some changes, and those changes are effectively going to make sure that this transition planning is true, legitimate succession planning from generation 1 to generation 2. So essentially requiring that the ownership, legal and factual control will pass from parents to child, that there will be a continued level of ownership and control by the parent, or sorry, by the child and not by the parent, you know, minimizing the amount of involvement that the parent can have, and also stipulating that there's a timeline in terms of, you know, how long this transition can take place. So, you know, would it have to happen immediately, or could it happen over a period of time? And the government is stipulating that that timeline will be something that they'll be looking at. Again, we haven't got those amended rules yet, so I'm not able to really provide much more detail. So, next slide, please, Craig. So again, this kind of feeds back into a little bit of what Sebastian was saying. So looking at you know, an asset sale versus a share sale. As I said, you know, asset sales are typically generally preferred by the purchaser, and share sales are typically preferred by the vendor for the capital gain purpose. So the pros as to why the buyer is looking typically to buy assets, because they'll get a stepped up basis of the cost in those assets, versus if they just buy the shares, they get basis in the shares that they're not able to take and deduct for tax purposes. Also, if the buyer is buying the shares, they're inheriting all the liabilities or the skeletons in the closet, which is why, you know, the reps and warranties would be something that would become very important for the buyer to be requiring. However, when you're looking at an actual sale of assets, you are now looking at provincial tax or HST potentially on that business that could result. If there's real property that is involved in the actual acquisition, then property deed transfer tax, property transfer tax would be a tax that would be a resulting tax. And then if there's things like licenses or other intangible assets that may have been acquired by that business that may be difficult to transfer from the existing owner to the new owner, by doing that as an asset sale, that may be more difficult or certainly require a lot more effort to make sure that those assets get transferred properly. Versus on a share sale, as I said, the vendor has the ability to claim their lifetime capital gains exemption, assuming the company qualifies. It provides a lot more planning opportunities. As I said, the ability to perhaps involve some family members to spread that capital gain around. It is generally a very simple transaction. I say simple with quotes sort of around it because all of these transactions are certainly involved, but less work than looking at all the various assets, and potentially if there's these harder to transfer assets. If you're selling the shares of the company, all of those assets will transition on the sale of those shares. Obviously, the vendor is looking for indemnities for tax and non-tax liabilities, and it does certainly require a higher level of due diligence to be entered into. So typically this would result perhaps in a differential in price. So if you're selling the shares of the business, you may be able to sell for slightly less than what you would sell the assets and still walk away with roughly the same amount of money in after tax. The next slide, please. So then I just, this last slide is really just some thoughts to consider. So after the sale has happened, there's still decisions that need to be considered. So understanding who you are as an investor, you're going to be now having probably a significant amount of money that has resulted from the sale. What are you going to do with that money? Trying to figure out whether or not you're going to be entering into philanthropic adventures or investing to provide a legacy for your family. So some of those decisions that you will need to make, as well as obviously planning for your retirement. Developing realistic goals, plans, and projections. So you've probably spent the vast majority of your life as a business owner, and now suddenly you aren't going to have that business to basically take up your time. So you do need to figure out exactly what you are going to be doing. Spending your time on, living off the investment income versus the business profits. So, if the business was a very successful business, a lot of times, people get used to a certain lifestyle, and will the proceeds of the business and the investment income that's going to be earned off that provide you with the same level of lifestyle? Often these transactions will have basically a continuation, so there'll be a vendor take back or some sort of an earnout or perhaps even a minority stake. So how does that factor into this in terms of what's going to happen after the sale? And then obviously estate planning, as I said, and a lot of factors that would need to be considered for that. So that's really the end of my part. We'll now, I guess, switch over to questions.
Yeah, thanks, Earl. There are a few questions in the chat room here that I thought maybe you could answer live versus replying via text. So I'll just read them out, and they're more kind of up your alley, if you don't mind, Earl. So
Sure.
one question that came in here was when using when using the family members in trust to allocate capital gains exemption, does that mean parents are using children's lifetime capital gains exemptions? And are there any issues that arise from this?
Yeah, so that's exactly what that means, is that you would be allocating the gain that would be arising in the trust. You'd be allocating that out to the parents. And if you're using the children as beneficiaries and allocating that gain out to the beneficiaries, they would actually be using up their capital gains exemption. So one of the discussions that we would typically have is making sure that the parents and the children are aware of that, because if the children later on become their own business owners, this transaction that would have happened perhaps when they were younger, will eat away at their lifetime capital gains exemption, and they won't have one in the future. The other issue, I guess, that arises from that, and CRA is typically very concerned with, allocating these gains out to other beneficiaries, that is really their income. So if you're allocating, $900,000 of a capital gain to children, that money really is for that child's benefit. There's ways that we can manage that income would potentially be put into a trust for that child for, their use in buying, funding their future university, housing purchases, business, their own retirement. But those monies really should be earmarked for that child in the future.
Yeah, thanks. Another question came in here. Is C208 planning only for family sales between parent and child? What about other sales such as to cousins?
No, well, it's not just parent and child. It could be grandparent to grandchild, but that is the only thing that was contemplated under C208. So sales between cousins and sales between siblings is not covered under the C208. So you would still be under the old rules with respect to 84.1 that would be covering those types of situations.
Okay, got another question. I can take this one. It's can you comment on a cash sale with a component of an earned buyout? How does that work? So I think it's more commonly referred to as an earnout. So what that refers to is when a lot of times it's with a third party. If there's a gap between what the seller is expecting and what the buyer wants to pay, a lot of times the way to bridge that gap is via an earnout. So let's say the seller thinks the business is worth $5 million and the buyer says $4 million. So the buyer says, okay, I will pay you $5 million. I'm going to pay you $4 million upfront cash because that's what I think it's worth. But there's going to be certain targets, metrics, which have to be met over the next 1, 2, 3, 5 years in order for you, the seller, to earn that additional $1 million. The targets can be on revenue, can be on gross profit, can be on EBITDA. There's all kinds of different targets, but it's basically a way to bridge the gap between expectations of seller and buyer. That's at a high level how they're done, and they're quite common nowadays in the COVID era, where it's more challenging to see into the future and see what forecasts are going to happen with businesses. So earnouts are quite common in the private company realm in the past 2 years, just given the challenges with being able to foresee beyond this COVID era.
And Craig, just on that as well, on the tax side, those earnouts would typically be considered, assuming they meet the criteria, and there are criteria that are set out by CRA in terms of these earnouts being considered to be proceeds. But generally, they would be considered proceeds and would be subject to taxes when they are actually earned and received as a capital gain.
Yeah, that's right. Thanks, Earl. So with that, unless there are other questions in the chat room, we have a few more minutes. We can hang around if anyone has any other questions. If not, I think the recording and the slides will be available to participants after this presentation. We did have a question come in here.
Yeah.
Can you
elaborate
just
on elaborating on cousins and sibling sales? So the old rules that I referred to, so this is this 84.1. So if an individual is considered to be a related party and they are trying to purchase the shares of another party, so we've got cousins. Now, cousins may not be a good example because they potentially could be considered non-arm's length. It will depend on the facts of the situation as they are defined under the Income Tax Act. But if we're talking about siblings, so if siblings are selling, between each other, they would be considered related parties for sure. And if they, if the shares of a operating company are sold to your sibling and your sibling uses a corporation to buy those shares, then that is going to trigger 84.1, which means that the capital gain that would otherwise be resulting from the sale will be converted into a dividend. And if you think back to that earlier slide, that dividend, will be taxable at, roughly 50% rather than at, at possibly zero, or, at worst, I guess, a 27% rate. So with cousins, it really is a question of fact as to whether or not the cousins are considered to be arm's length. And that's a much more involved discussion, the way that it is defined as related parties under the Act. But generally, they can be considered non-arm's length, and those same rules would apply.
Very good. Thanks, Earl, and thanks everyone for your time. Really appreciate it. Feel free to reach out if you do have any questions offline. Again, you're going to be sent a copy of the recording, I think, via link, and a copy of the slides. So appreciate everyone's time, and have a great rest of your day.